Hey guys, this is Zero X Wing.
And this is Tratium.
Sup, Tratium. And you are listening to the Runebase podcast. And here at Runebase, we offer guides, news, and updates and resources in this podcast, mostly on the Thorchain ecosystem and about decentralized finance at large. And today we had the pleasure of speaking with Dima, Matt, and Rulin, three of the team members on a project called BNPL Pay. And Tratium, what is BNPL Pay?
BNPL Pay is a buy now, pay later protocol that aims to provide uncollateralized loans in the DeFi ecosystem, which is something that really isn't available right now in DeFi. You have collateralized loans where you provide collateral in excess of what you're lending in return. But to get uncollateralized loans is a kind of a new primitive that BNPL Pay aims to provide.
Yeah, it's interesting. And so they kind of bridge these worlds. They're calling it CDFI, or it's been called CDFI, where on the borrower side, borrowers are able to get loans without collateral. And in order to do that, there's centralized banking nodes that determine some level of creditworthiness through different means. And then they also keep those borrowers accountable through different means as well. And so this bridges the world of centralized finance, which has uncollateralized lending, obviously, like with credit cards and other lending instruments. And then on the back end, as they call it, the lenders can participate in a DeFi style lending environment and get great yields. At the time of this publishing, this will go live here in early September. Next week, there's going to be 2 different token sales for BNPL on Thorstarter on September 14th and then Balancer on September 16th. And yeah, Tratium, what do we have to look forward to there?
The Thorstarter launch on September 14th. They'll be selling around 5 million tokens at 4 cents. So it's a great opportunity for those as part of the Valhalla Venture Fund to be able to get in at a very early access price. And then the following sale on Balancer, the sale will be starting around 80 to 90 cents, which is a good opportunity with much higher caps. So if you weren't able to get in on the smaller Thorstarter sale, you can head over to Balancer and participate there as well.
Yeah. And then it'll be a reverse Dutch auction on the Balancer sale. So it'll start at 80, 90 cents and then just like back down towards 4 cents over time. Yeah, so we had a great conversation with them. The team is super knowledgeable. They have a background from the traditional banking world. We talked about BNPL, the mechanics, the team, the macro context, and just getting excited about these upcoming launches. So that we get to look forward to. And Trey, what else is going on in your world right now? What's going on in the Thorchain ecosystem?
Well, from us on the Runebase side, we have a very exciting announcement of a upcoming NFT project that will be releasing shortly. We'll have some teasers put together soon and ready to get the Thorchads excited about having a high quality NFT project that they can call their own.
Exactly. So at the time of this publishing, we will be announcing ThorPals. That's thorpals.com and thorpals_NFT on Twitter. It's a really fun and, as you said, high quality generative NFT project that we designed really to do something fun for the community. And so you can check that out at thorpals.com to learn more. And we'll be announcing it here on the Runebase Twitter as well, and more details there to come. So keep your eyes out for that. And other than that, Trey, anything else?
That's it. Is there anything else?
That is it, folks. Well, hope you enjoy the interview and we will see you on the inside. Peace. Hello, everyone. This is Zero X Wing and Tratium from the Runebase podcast, and we're joined today by Dima, Rulin, and Matt from the BNPL team. Guys, thank you so much for joining us.
Yeah, thanks for having us, guys.
Good to be here.
Absolutely. Well, I think a great place to start would be just like a round robin introduction of each of you. Tell us a bit about who you are and the work you're doing with BNPL.
Sure, I can kick off. My name is Matt. I'm Dubai-based, at least most of the time. Background is finance, strategy, and operations. So I started my foray into blockchain, I guess it would have been around 2016 as an angel investor in a very early enterprise blockchain company. That experience took me to actually be a team member there and working with multiple corporate clients primarily throughout the globe on incentivizing distributed ledger technology into incentive use cases. So from that time, I've helped also through my consulting capacity on assisting with ideation, governance, fundraising, basically everything within projects within the crypto space. I'm primarily leading operations within the BNPL team.
Cool. So Matt on operations, and Rulin, how about you?
Hey, I'm Rulin. My background is in finance. In terms of qualifications, I hold an MA from Columbia University, and I'm also a CFA charter holder. With regards to BNPL, I helped design a lot of the financial side in terms of the incentive structure and the token model for the protocol.
So that's Rulin, sit on the finance side and incentives. Very cool. And last but not least, Adima.
Hey guys, my name's Dimmer. I'm in charge of product, so I'm leading sort of design and, kind of a forward plan for what the product will look like and how users will interact with it. As far as my background, I've been in crypto from quite early on. I've been from around 2013 days. I was involved with everything from mining to consulting to ICOs to building products. And over the last year and a half or so, I've gotten heavily into the DeFi space. Every facet of DeFi I'm involved in, and kind of was a natural fit to try and develop a DeFi lending product such as the one we're trying to build.
Well, let's start with the most obvious question. What is BNPL?
Well, we refer ourselves as BNPL Pay. Are you asking about the protocol, or are you asking about buy now, pay later in general?
Well, let's start with, what is BNPL from a high level standpoint, just generally in the financial industry?
Sure. Well, from the high level, BNPL stands for buy now, pay later. So this is a relatively new fintech product, which sits as an abstraction on top of credit cards, whereas people that potentially have consumption needs that can't be fulfilled by their current access to credit, these third parties come in and essentially provide them with credit facility to purchase their needs without the capital, and they can pay for that over a longer time frame with a very low to 0% interest rate.
Thank you very much. So I think most people are familiar with that in traditional financial industries with loans and such. So what is BNPL Pay, and how do you guys perform that BNPL service for the DeFi industry?
Yeah, so BNPL Pay is a decentralized protocol, and we're tackling some of the key challenges within the DeFi environment. The naming mannerism here kind of came around, I guess, the fact that the core backers and early founders of this idea and the protocol have a very strong tie to the buy now, pay later space. Australia is where the majority come from, and this is a location where BNPL is very well known. Some of the early movers in the space came out of there, and we all know the recent acquisition by Square of Afterpay. So this is why we look at it as being a very interesting opportunity. But the key mechanisms within the protocol is, two key points. One is lending to uncollateralized borrowers. This is something that's not very widely done so far in the space, so it's quite novel. And the second is bridging into the much, much larger environment of corporate borrowers and the off-chain world. So BNPLs are interesting because, especially the small to medium enterprise players, they offer an opportunity. Their cost of capital is substantially higher than the rates that we see in the DeFi space. If you look at protocols like Aave, they tend to trend down to 2 to 3% sustainable returns once the emissions are all used up. And we see the borrowers in the BNPL space as being very attractive for rates in multiples of this. So the idea here is to create a protocol whereby we provide much stronger yields, sustainable yields, to the DeFi holding asset holders, and we provide slightly lower interest rates for the off-chain corporate borrowers.
Can you talk a bit about how this brings uncollateralized lending? I think most in DeFi, all our audience is familiar with collateralized lending in DeFi. And as a mechanic, it makes sense. A lot of times these are collateralized or over collateralized loans. And then you talk about in centralized finance or traditional finance, actually, you have creditworthiness based on, credit history, obviously a known identity and a human being like body that you can hold accountable for any loans taken. So if you're going to do uncollateralized lending, can you talk a bit about just the simple mechanics of what that looks like? What incentives do borrowers have to pay back if there's no collateral? How are they held accountable to the loan that they're taking?
Yeah, so as you said, for unsecured loans, there requires a centralized entity that needs to be held accountable for making sure loans are paid back. That's why we chose a DCFi approach. Since to tackle uncollateralized loans, you need an entity capable of contract enforcement to make sure borrowers have the incentive to repay their loans. A purely DeFi approach we think is naive. It's possible with something like a DAO, but without a centralized entity enforcing these contracts, loans would only really be granted to big names in the space that leverage their reputation. But the problem here is these big name players in the space, they already have sufficient capital to take loans from things like Aave anyway. So there's not really going to be much value add in the ecosystem if you use this approach. In terms of our protocol, the incentive structure was more designed around banking nodes and making them bond tokens that can be slashed. That way, we ensure they do their job thoroughly in terms of doing things like credit checks, chasing up loans, and things like that.
Yeah, I think just to add on that, the incentive mechanisms are built around the banking node, who these corporate entities, typically going to be corporate entities. It's their responsibility, the same way it's a bank's responsibility or a off-chain lending corporation's responsibility to look into the creditworthiness of the corporations they're lending to. It'll be the exact same way in that sense. If they make bad loans, obviously that's going to be very transparent in the history of the banking node transactions. We'll be able to see defaults, and the incentive model is built such that these banking node operators are penalized through slashing. From the borrower side, it's the same as in traditional markets, but the lending side of things from the protocol operator or the banking node operator is where the incentives come in more strongly, and we built our product around.
Yeah, just to go off that, so how we structured BNPL is that it's decentralized in the sense that anyone can come in and create a banking node by just bonding 1 million tokens. That shows you have a commitment to run the node properly, since you have to put up a significant amount of capital at the start. This is, I guess, the same with a lot of protocols. I guess the one people would probably be most familiar with is ETH 2.0, where people basically need to commit 32 ETH, which can be slashed if you go offline. So that makes sure nodes are running all the time and doing their job properly. Another mechanism we have in the protocol is that users can stake additional tokens to a banking node. This allows just holders of our tokens to share in the rewards of running a node, and at the same time, they also help insure the lenders. So how this works with the insurance is that the bonded and staked tokens can be slashed, and basically they get slashed if a default occurs, and the slash tokens are forfeited to the lenders to rebate any kind of losses they might suffer. And then that way, the wins and losses for lenders, stakers, and banking nodes are all tied together.
In that model, the ultimate liability of potential defaults rest on the shoulders of the centralized nodes. Like they would be the quote unquote bag holders if a borrower was to default.
So if a borrower was to default, it's a burden shared by everyone. The banking nodes have the power of mitigating the risk since they control who is granted a loan. But in an unsecured loan environment, they can only mitigate the risk. There's always going to be defaults and unforeseen circumstances. So it's not full liability given to the banking nodes like in a waterfall structure, I guess. It's not first loss capital. Instead, slashing refunds are given to lenders. That's only a percentage of their total loss. So all stakeholders in the platform share in the loss.
You touched on this briefly with the, it requires 1 million BNPL tokens to bond to a node and create one. That sounds very similar to like Thor nodes, very high capital costs, but it's also a ton of responsibility to run one of those nodes. So I'm seeing some similarities here. And in the case of like Thor nodes, you don't need quite as much, institutional like banking knowledge to run a Thor node. You just need to be like a savvy DevOps person. But in the case, with Thor nodes, there's a kind of mix of ANN single users who just happen to have gotten in early, have the tokens to run a node and have the technical expertise to do that. There's also some like more institutions running nodes that have like full-time DevOps teams and like actually, 24/7 support for those nodes. And so there's this mix of just regular users and kind of professional entities. And in the case of BNPL Pay, who do you expect to be the usual node operators? Is it going to be mostly kind of experienced institutional type banking types that already know the ins and outs? Do you expect any kind of regular type users with a lot of tokens to run a node, or just these kind of professionals?
So yeah, in terms of comparing it to Thorchain of creating a node, it's pretty much the same. You're just making sure that the user is committed, and in both instances, the node operator has a lot of responsibility. But in terms of who will run a node on BNPL versus Thorchain, it's a bit different since the rewards come a bit differently. Basically, to run a node profitably on BNPL, you need to have lenders commit capital, which is unique to our protocol. So that would likely require institutional type reputation to get that kind of capital. And we expect the people running nodes would mostly be institutions with the facility set up to protect their lenders' funds. But that being said, it wouldn't be impossible for an individual or community to run a node in, for example, a DAO structure. Just as long as they're able to get lenders to the pool, anyone will be able to run a node profitably.
We envision it to be primarily used for off-chain transactions that are uncollateralized or under-collateralized on the borrower side. But there's no reason why a banking node can't be run, as Rulin said, by a DAO that wants to do on-chain partially collateralized loans. Maybe they put a threshold of 20% collateralization to take loans. They only lend to trading desks or other on-chain entities that require this. And in these situations, it might actually make more sense for DAOs to run them. But we do envision our very large AUM handling nodes to be regulated entities that have banking teams, connections to off-chain order books, and these kind of things. Yes.
With that, across different nodes, will each one of them maintain different standards of either, in some cases you mentioned like partial collateralization, but even like identity, maybe they have their own credit scoring or credit worthiness systems. Do you imagine like just a range of credit worthiness evaluations across different nodes, or are you going to champion a standard to be set across the banking nodes?
Yes, we definitely wouldn't encourage a standard for all nodes to follow. We would encourage as many nodes as possible to run as varying strategies as possible. Our thesis basically is that to get the best rates to the market, we'd want maximum competition between nodes. So with that, we designed our protocol so that nodes have to compete with each other, both in terms of getting lenders and fulfilling borrower requests at the lowest rate they can afford to. And with this, we hope over time that basically our protocol will be able to give the best risk to return on all levels of risk that lenders are willing to accept.
So is there a unified marketplace front end that end users will be able to log into? I'm kind of imagining something like Nexus Mutual, where users log in to the DApp and see a list of provided insurance offerings and can compare and contrast. I guess with Nexus Mutual, you're comparing different protocols, but it's not just comparing rates for a single offering. But is there going to be an interface like that, or NerdWallet, where you log in, type in I'm looking for a car loan, whatever type of loan, and they give you a list of APRs and reputation scores and stuff like that, and you as the user can choose which one seems to suit you the best?
So the way we've envisioned the actual product design is a twofold system. On the back end, we envision a DeFi native and DeFi friendly environment. That is to say that all of us as participants in the DeFi space are very comfortable with MetaMask, very comfortable with Aave, very comfortable with lending protocols. We know what to expect. So the design ethos for someone that's going to be providing capital to the platform, stablecoins, would be something that's native and familiar and feels comfortable to a DeFi entrenched person. On the front end, for the borrower side, we envision a more TradeFi friendly interface. So I envision this as a sort of a system, two systems or two sides of the same coin. On the front end, the DeFi side, the front end is concerned with legal, with loan terms, with, hey, click here, receive your money sort of stuff. So the front end would basically be a interface that funnels users to submit their loan terms to a multitude of banking nodes, so broadcast their terms to a multitude of banking nodes, and the banking nodes can compete for the said business by negotiating rates and offering a better return and so on and so forth. On the back end, a user would see, as you described, a list of nodes. So you would see a fully filled list of nodes with a full transactional history facilitated by a blockchain transaction history. So we're talking historic returns, historic default rates, TVL, amount of stakers, etc. All the information necessary for all users in the interface. So from stakers to lenders to borrowers to assess how they wish to deploy their capital. And basically, we envision a complete DeFi standard in terms of that. So using the best practices available in the industry, we're talking Aave, Compound, etc. We're going to build on the shoulders of giants. We're not going to reinvent the wheel here, but we do envision doing something differently in the end of the end user, which is a borrower, which basically hides the DeFi side and facilitates an easy mechanism to borrow capital.
Got it. And then I don't know if this is something that you guys are going to design or something you leave up to each of the individual banking nodes, but in traditional finance, when there's an uncollateralized loan and the borrower defaults, the centralized lender often takes it upon themselves to recoup their borrowing, sometimes either through a process of collections, like a collection process, or a repo process, or maybe just by selling the debt to another buyer. Do you imagine any mechanisms like that making their way into this relationship between the banking node and the borrower? Any thought on what that might look like?
Yeah, so it would be up to the banking nodes in terms of that, and we expect it to work pretty much in the same way as DeFi in terms of debt collection. In terms of the protocol design though, since debt collection can be very slow, and if a debt collected is after a loan is considered defaulted, it doesn't just go into the pocket of the banking nodes. Instead, it gets offered back to the lenders since they were the ones that lost the money in the first place. But in order for them to claim this money, they have to return back the BNPL tokens they were given as the slashing compensation. And they basically have a window to take this option. And if they don't, the funds then are given to the node operators and stakers to recoup the tokens that they lost from the slashing.
So how would you deal with the regulatory issues? So for example, Aave has recently introduced like two separate pools for LPs, KYC LPs and non-KYC LPs. With BNPL Pay, you have individual banking nodes that can kind of set that up. KYC is generally what they're going to be doing. If they don't want to use KYC, I assume that's up to them. And they can, if they're running a node and have the tokens to bond, to create a node, they can have whatever rules they want. So from your perspective, what are the different regulatory requirements between these two different potential banking node types?
At the protocol level, we're less restricted by regulations. We're building the tools and software to allow this ecosystem of non-collateralized lending, bridging that gap. But it's the banking nodes that set up a jurisdictional requirements that require the jurisdictional based licensing. We might envision in Singapore, for example, if you raise from a group of individuals, whether they be whitelisted or not, and they're not accredited individuals, you're probably going to need some form of crowdfunding license. So we imagine you would need a lending license within Singapore that has crowdfunding attached to it to be able to take on that responsibility, whether or not those accounts are whitelisted. Again, we'll create the templates and functionality for any banking node to be able to do this kind of stuff, but we'll leave it up to them which markets they operate in, which regulations are required. We'll put all the required documentation and signups in place to set up your own banking node to do this. But again, this is very agnostic in the sense that should a node not want to touch the off-chain ecosystem, they want to do uncollateralized or partially collateralized lending on-chain fully, they can do that without worrying about the C5 regulatory issues.
Awesome. Yeah, this is obviously a very novel concept. I mean, centralized lending in traditional finance is, a centuries-old practice at this point. DeFi is this new frontier, and then this kind of fusion, if you will, centralized, decentralized, uncollateralized or semi-collateralized loans is a very novel concept, a frontier of a frontier. So it makes sense to me that from a borrower standpoint, people would love to get loans. From a lender standpoint, people would love to put their assets to work. And maybe the novel introduction here is this banking node. It seems like to me a new role, a novel role for an institution or in some cases, perhaps a DAO in the future. I'm curious, how far along are you with that stakeholder, like the banking node? Can you talk a bit about relationships that you've built or conversations that you've been having with potential banking nodes and what level of excitement or interest there is in this from that player?
Yeah, again, this comes back to the founders and the backers of this project. There's a very strong depth of understanding the market and connections with big players in the space throughout Australia and globally. So the legal ramifications, what we're trying to work out still, we have the ability to bring on these types of partnerships, but we have to understand whether that comes at a protocol level or whether that comes at a banking node level. We don't necessarily have the ability to go out there as a protocol and sign MOUs and letters of intent with large, say, BNPL operators or point of source financing companies or whoever it may be in credit markets that would either want to run these banking nodes or would be, I guess, the borrowing order books for these banking nodes. But the conversations are there. And this is why the majority of our bankers are in that space. They saw a solution for both sides of the equation. One is providing new liquidity at a slightly lower cost to the C5 borrowers, and one is providing much stronger sustainable yields to the digital asset holders that, as we said, currently today are trending towards 2 to 3%. So the interest is there. The conversations are there. We just have to find out the legal ramifications. So does that come in at a protocol level or does that come in at a banking node level? And this is some of the conversations that we're currently having with Dens, which is our legal counsel out of Singapore.
Sounds good. Yeah, I'm curious, well, there's a whole rabbit hole of legal ramifications that we could go down, but I want to circle back to something you said at the top of this, which is that this is where the background and relationships of your founders come into play. And I think that's an important piece that to understand here. Can you tell us a bit about the genesis of BNPL? Who are the founders? What are those relationships? And how does that set the stage for BNPL being a successful project?
Yeah, well, the original ideation from a super high level, I suppose, came from a group of backers who are TradeFi executives, primarily based out of Australia. And they've been instrumental in funding and growing several BNPL companies over the last 12 months within the region. So they were able to see the need on, I guess, the Cefi side. And these are also gentlemen who were involved in multiple different investments in the crypto space over the last 4 years. So this is where the high level ideation came from. It was a matter of how do we provide lower cost of capital for the BNPL companies, and how do we bridge that into providing better yields for the digital asset holders within the DeFi space. That was a very high level, and those are the team that came out of. And this is what brought into building out this team, which is, quite large now. And we also brought on a very strong technical team. We can get into the smart contracts and where we are with that, with audit, with everything else. We have a gentleman by the name of Edward Chin, who is a owner of a buy now, pay later company out of Singapore, CEO of a company called Octify. We have some pretty deep experience on the team, both on the CeFi side and the DeFi side, that we're able to leverage to build this out. So it's, again, the conversations are all there. It's a matter of how do we bring those conversations in? Can we do that from a protocol level, or do these backers have to come in and potentially stake their own banking node and then build the relationships on through leading the way? You see many of these foundations, they take on the first node operation, they build out the relationships through that. That very much may be the case with our protocol, given the real world touch points and the regulations associated with that. But these are the things we're working through right now. The main focus has been assuring, I guess, the incentive mechanisms, the novelty of the model, that we can actually do what we want to do here. And beyond that, it's how do we grow out the order books, which are already in place. It's just a matter of, again, how do we integrate those?
Yeah, so in addition to who you already mentioned, who else is on the team, or at least how many people do you have working on this, and what are the different roles you guys have? How many people are working on cracking it from the protocol level, legal side, and making kind of partnerships and stuff like that? What's the scale of this?
Yeah, so as I mentioned, we got the founders. They're helping primarily with capital raising, with business development, with relationships on that side, and dealing with the compliance side of things. So we've retained Denton's, obviously a global law firm, but primarily we work with the Singapore office for all the legal and compliance around capital raises, around the IDOs, around structuring this, banking nodes, just where does the risk sit? How do we put our risk statements in place? Everything from that perspective. Deem on the call, obviously, from a product, Rulin from a math, finance, and incentive model side. We brought on a company called Tiencia for the front end development, as well as helping us with building out the applications, that side of things. We have two very talented smart contract engineers that are building out the banking nodes right now. We've already engaged Hacken from a audit perspective to be assisting with security and making sure all the smart contracts are good for the MVP, which we tend to launch November at the latest. So about a month and a half after our IDOs. Bringing on a CMO as we speak, actually. So we have a new CMO who we can announce in a few days, but you'll have to follow the medium, I guess, to see that. And then, as I said, we have an advisory board, as I mentioned earlier, that's focused more on the BNPL space to really get buy-in from the industry, understanding the unique touch points within there, because this is where we want to really focus the order book from a borrower perspective from the get-go.
Awesome. Yeah, sounds like a fully fleshed out team, and it's great to hear that there is that focus on the legal and the regulatory side is a major component here, and it's great to hear that the founders are involved there. I'm curious if you can shed some light on how big this gets. Obviously, the founders that you mentioned have built BNPL projects before to a significant scale. How big is this opportunity globally? And when you think about the potential and the market size for BNPL Pay, how big does it get?
Well, this is where it comes down to the name being a little bit underwhelming, I think. Yeah, the size of the BNPL market is obviously massive. We saw Afterpay be acquired for 29 billion, I think it was, by Square. So this is just one player in the space. So we can see the size of the market. When we compare that to somewhere around 80 billion for all AUM within the DeFi space, this is just touching this one touch point is quite strong, but we look beyond that. The buy now, pay later space is not the end all be all. It's where we intend to seed this and launch. Let's call it our MVP, I suppose. So when we discuss credit markets, all point of source financing companies, people that are paying, let's call them north of 6% cost of capital, that we can then push forward onto the banking node operators and to the lenders, which is substantially higher than the current ecosystem of sustainable yields within the DeFi space today. It's many, many multiples of the current size of DeFi markets. So even if we look at the leader in the space of approximately 20 billion AUM, the markets we're going into look at global credit markets. It's a massive opportunity for us to get into. We're not thinking that we're going to take over the space, but it's a very interesting and exciting market. And I think it's a natural progression of this industry, both in terms of size and more sustainable yields.
How do you view the competitive landscape?
Yeah, so that's one of the exciting parts in terms of competitors. So there's a few other protocols in this space, but there's nothing really established or a go-to thing for like collateralized loaning, such as Aave. And there's not really anything that's being launched that has a similar structure to us. So we'll definitely have a nice first mover advantage. With regards to other protocols that are launching, they typically lean towards a more pure DeFi focused solution. But we don't think it will necessarily be as effective as BNPL, since the DAO isn't necessarily the best way to tackle a lot of the problems with unsecured lending, as I also touched up on earlier. And then as a result, we don't think they're going to be able to service a big chunk of the demand in this space. Whereas BNPL, we think we can capture we can cast a much wider net and capture a much larger market.
Interesting. Now, we are, maybe at the time of this publishing, we'll be maybe a week or so away from the BNPL launch on Thorstarter. And so with that, we're interested in the upcoming IDO. And first, a bit more on the token mechanics. So the role of the BNPL token in your ecosystem, you mentioned first that anybody can create a banking node. They stake 1 million BNPL tokens. Is there any other utilities for the BNPL token in the ecosystem?
So firstly, with the token's utility, there's obviously the governance, like with all other DeFi protocols, where the future direction of the protocol is voted by all our token holders. In terms of the incentive structure, I think this is where the token serves a very big utility, as it aligns the interest of all the stakeholders on the platform. So basically the functions, firstly, there's bonding, which we already talked about, where you need 1 million tokens to set up a banking node. And these tokens can't be withdrawn until the banking node closes their operations. This ensures a commitment to run the node. And if you get slashed below 750,000, the node can no longer issue new loans or take in more capital. So they basically have to either top up or cease operations. Then there's also staking, which serves as a vouching system. This lets token holders share in the profits of the banking nodes by earning a part of the interest accrued, but it also acts as an insurance fund for the lenders. So one of the most interesting dynamics of the protocol is that with each node, there's a amount of staked tokens and an amount of liquidity lent. And with this, we can get the staked assets to liquidity ratio, as we call it, which is the equivalent of the percentage rebate lenders get back when there's a default. And what's really good here is that this ratio isn't set by us, it's set by the market, and it's self-rebalancing. So what this means is that, for example, when the ratio is low, this means there's very few stake tokens, but a lot of liquidity earning interest. So stake tokens will have a very high yield, which will encourage more stakers to come in and push this ratio up. But when the ratio gets very high, that means there's a lot of stake tokens relative to liquidity. And what this means is there's a very high insurance cover for lenders, so that if lenders lose any money to defaults, they'll get back the majority of their funds. And then so when this ratio is high, basically lenders will see it as being a low risk pool to lend to, and they'll jump in and push the ratio back down. So with this, the market will naturally discover what kind of cover is deemed fair for each of the banking nodes.
Got it. So the banking nodes bond 1 million BNPL tokens, and then other users can stake with the banking node, and that's a little bit more liquid and more fluid. Do I have that correct?
So I'll kind of clarify it in a simpler sense. Bonding can be seen in the way that if you are about to go to court and the court is worried about you skipping town, you need to bond a certain amount of money. That money guarantees that you show up or you lose that money. That is the exact essence that bonding is used here. Bonding is used as a way to guarantee that you're going to be a faithful operator. So we are aiming for a system where the cost and the rising cost of a token would cost the user too much money to try and defraud or run away or not do due diligence on borrowers. So the utility of bonding is to promise and to say, hey, look, we're putting up money. We promise to look after our borrowers and lenders' interests, and this is what we are giving. Whereas stakers is more of an outside perspective. Stakers also, in essence, vouch, and in fact, that's something covered in our white paper extensively. A staker vouchers for a node. That is to say that they come into the ecosystem, they look at the available nodes, they go, hey, there's a node that's offering 12% interest rate. I like that. There's a node that's offering 40% interest. I really like that. But then they have to stop and think, if I'm going to stake and reinforce a certain node and say, hey, I vouch for that node, are they going to run off and screw up with the lender's money? Why are they offering such a high interest rate? Are they capable of delivering due diligence? So a staker's role in the system is an outside voucher. They vouch for a node, and in response and in return for vouching, they receive a share of revenue, but also they stand to lose a portion of their tokens, much like the node, in case a default occurs. So that's sort of the vast difference. I wouldn't say vast difference, but the crucial difference between someone that is creating a node and someone that's an external party that's simply vouching for a node.
Got it. Makes sense. Now, you mentioned earlier, did I hear correctly? Correct me if I'm wrong, but to bond for a banking node, it takes 1 million BNPL tokens. Is that correct?
That's correct.
Now, is that a minimum? And then is there a limit to how much lending a node can oversee based on the size of the bond? Like, is there a bond ratio that must be met, or is it 1 million and then it's like have at it?
Yeah. So with the bonding, it is 1 million. That's the minimum. And if they get slashed below 750,000, then the node can no longer take more capital and it cannot issue out any more loans. So basically, it just becomes inactive until they top it back up. And they obviously can't get back their $750,000 tokens until all the loans that they have outstanding are repaid and given back to lenders, if they choose not to top it back up. And then in terms of the ratio, that's where we just it's a self-rebalancing because that's why we have the staking and the bonding. So when a node is running, it has a certain amount of staked assets and a certain amount of liquidity, and that's where we coined like the staked assets to liquidity ratio. So basically, imagine you're running a node and you have 1 million tokens bonded and 1 million tokens staked. Then there'll be a total, and then let's just, for example's sake, say BNPL is trading at $1. So there's $2 million of staked assets here. And then if your node had, for example, $4 million lent to it, then the ratio would be 0.5, which would also be the insurance policy given to, I guess, the rebate percent given to lenders in case there's a default. So for example, if all $4 million was lost, then the lenders would receive $2 million in assets, and it's proportionate. So if they lost 200,000, they'd receive $100,000 in assets. And then that's where the market rebalances to get the ratio that I guess lenders and stakers deem appropriate. So for a very trustworthy node, the ratio might be low. For something much more speculative, it will be a lot higher. But when the ratio is very high, it makes it very, I guess, favorable to stake tokens to the node. Because if there's a lot of if the ratio is, sorry, okay, let me just make. Yeah, so if the ratio is very high, sorry, I mixed it up. So I guess cut that bit out. So if the ratio is very high, it makes it very favorable to lend money to the node, which would push the ratio back down. Because if the ratio is very high and you lend money to the node and there's a default, if, for example, the ratio is almost 1.0, you'd get all your money back if a default happens. But if the ratio is very low, it makes sense to stake to that node and push the ratio back higher. Because if there's a lot of liquidity there and very few staked assets, the few staked assets share a percent of the interest earned by that large liquidity, so their return should be substantial.
It'll balance out by profit-seeking stakers, essentially, who will lend more security if the liquidity is higher.
Yep. So it's a counterbalancing act on both sides.
Got it. And if I lend into a BNPL Pay node, are my assets represented by something like I don't know if LP is the right term here, but like a token? And do you imagine like this backing up to composability in DeFi, so I can take that LP token and yield farm it or collateralize it somewhere else? Do you see that happening?
We would expect secondary markets to pop up. So the practical problem of liquidity pools is if 100% of the liquidity is lent out, it's not possible for a lender to pull out their assets until the liquidity pools are refilled. Now, a similar problem exists on Aave, except Aave has $20 billion in TVL, so it's a little bit mitigated. So to answer your question directly, yes, it is represented by a token. And in theory, a secondary market, we can't possibly prohibit users from creating a secondary market to trade their liquidity tokens for a premium. So we do envision, although we cannot, of course, comment on that would be like commenting on price, but of course it's DeFi. So it's impossible to prohibit something like this occurring. But yes, I'm sure that secondary markets could appear for this sort of thing.
All right, so you have your token sale coming up on September 14th and September 16th. The first one is at Thorstarter, and the second one is a Balancer LPB sale. Would you like to explain the difference between those two and what users should be expecting for these different sales?
So the Thorstarter sale catered primarily for the Thorchain community, given that it's running on the Thorstarter platform and requires X-Rune token. I'm going to stop short of saying it's an exclusive sale because anybody, of course, can get into the sale, but we do envision that the majority of purchases are coming directly from the ThorFi ecosystem that are enthusiastic about projects running on anything to do with Thorchain and ThorFi. So that sale's priced at a flat price of 4 cents, which is actually our private sale price. So getting in on the sale at that price basically gets you the lowest possible price that you could have entered our project at. The Balancer sale is a different structure. The Balancer sale is a much bigger sale. So the Thorstarter sale will be looking at selling 5 million tokens at 4 cents. So we're looking at a total cap of $200,000 to be raised on Thorstarter. The Balancer sale is a slightly different structure. It follows the standard Balancer LBP structure, which is a 3-day sale that starts at a significantly higher price and over time drops down. That is to say that the starting price could be as high as 80 or 90 cents, but the ending price on the third day would be the private sale price. And if no purchasing occurs at any stage, the final price on the last hour of the sale would be the same price, 4 cents. Those numbers are obviously unpredictable. It depends on demand. It depends on the average purchasing price. But we do find, and one of the main reasons why we chose a balanced LBP is that it is the fairest distribution system of an IDO. I would say, having been in the space as long as I have, that there isn't actually a better system than the balanced LBP in terms of distributing the token into as many hands as possible. So that was the rationale for the two sales. In summary, a semi-exclusive sale for the ThorFi community via Thorstarter, and a more open and public sale conducted on the Balance LBP.
Yeah, that seems like a very fair launch. And speaking of the kind of catering towards the Thorchain community, what is the kind of end game tie-in for BNPL Pay and Thorchain? How do you see these two projects coexisting?
Sure. So as part of our initial discussion with some of the key guys that basically funded Thorchain, and we noticed that there's sort of a gap in the market in the ThorFi ecosystem for lending products, for collateralized products. Given that we're sort of building a unique uncollateralized platform, we thought that it's a pretty natural fit. And the natural fit comes from the fact that a lot of the original guys for the project are Australian. And a lot of the Thorstarter sort of community and a lot of the Thorstarter founding is from that part of the world as well. So we consider Thorchain, I'm sorry, I meant to say Thorchain. We consider Thorchain to be a disruptor, an innovator, and of course, Australian. And given that we're a disruptor and innovator and also Australian, we thought it's only fair that we cater to each other's needs. And our long-term plans are to develop an exclusive platform for the ThorFi ecosystem in the collateralized and uncollateralized lending space.
Very cool. And it's very interesting as well to see kind of the similarities with like the bonded nodes and stuff. I'm seeing more and more projects have actual like token utility popping up and having, a lot more thoughtful incentive pendulums, as I think Thorchain probably coined, supporting the protocol itself. It's very interesting to see. It's kind of a new wave of primitives that I think will be very long-lived because they actually have, utility to the tokens and kind of this pendulum that makes sure participants in the network benefit accordingly.
Awesome. And then in terms of timeline. So as Tratium mentioned, we're looking forward to the Thorstarter launch and the Balancer launches here in mid-September. What beyond that in terms of, you mentioned earlier, there's some, legal or regulatory open questions. And then what's the timeline to kind of working through that versus getting to MVP or beta release versus getting to like a 1.0? Curious if you have any insights into what we have to look forward to.
Well, the regulatory challenges are more focused on what we do versus what the banking nodes do. There's no question in our minds that we can enable what the protocol intends to enable. It's a matter of split of responsibility between what does the protocol take on and what do the banking nodes take on. We would like to offer as much as possible at a protocol level for tools, templates, interfaces, but that is more where the questions come around. So those legal requirements are not so much based or restrictive to a launch date. I'll let Dima handle the product launch and the MVP as he's had a product, but I just wanted to handle that regulatory issue first. And the regulatory issues we're dealing with aren't operational in nature. They're more, where does the responsibility sit for certain parts of the holistic solution?
As far as the product, we kind of run by the ethos of under promise, over deliver. So when we say MVP is probably underselling a little bit of the plans. To give you a little bit of an insight into development, on the smart contract side, we're probably 80 to 90% complete. On the front end side, where we're delving in now, the front end is a little bit less complex than the back end stuff. So when we say MVP, I sort of see the product launch as being our beta. So a beta is generally a feature complete platform ready to operate, but not beta in the sense that we are risking user funds. We're getting a full audit. We're going to be on Immunify, which is of course a bug bounty. So when I say beta, I'm referring to the full spectrum of features that we plan to deploy. The core features for the platform we do plan to have released within approximately 2 months, 1.5 to 2 months of the sale. As far as a long-term roadmap, we want to delve deeper into uncollateralized, collateralized, and eventually onto the actual buy now, pay later sector, which is our namesake. And that's a far more technical, complicated problem that I would envision that within a couple of years, let's call it 2 years, I think is a realistic roadmap, a DeFi-centric protocol such as ours would be able to completely facilitate.
Well, this was all very informative. So where can we follow along for updates and Twitter, Medium? What resources do you guys have for our listeners to hear more about upcoming token launches and updates to the network?
So our website is, along with all of our hashtags and all of our captured usernames, is BNPLPay.io is the website, which currently it's a landing page and being upgraded to a full site very soon. Twitter hashtag is @BNPL Pay. You can access all of our mediums, all of our channels, all of the information, including the white paper, is deployed across all of the socials. We've got a very in-depth white paper that we hope is going to be read by as many people as possible. We've put in a lot of effort into creating a succinct product. We've got very helpful and in-depth articles for both Balancer sale, the Thorstarter sale, and of course, the general use case of the platform. And we would love for as many community members to come in, ask questions, give us criticism, and participate in discussions with us.
Awesome. Well, guys, thank you so much for taking the time and sharing this with us. We are super excited to watch this roll out over the next week here with the Thorstarter and the Balancer launches, and follow along in the next, hopefully, month and a half, 2 months to see the early versions of this peek its head above water. We'll look forward to seeing that all happen. Thank you again.
Thank you for having us.
Thanks, guys. Really appreciate the time. Thanks a lot, guys. Have a great day.
Yeah, thank you.
Thank you guys too.